Hello and thank you for joining me. In the first video of this two-part series, we discussed how inflation can negatively impact your retirement when it gets out of hand and why retirees in Canada can no longer rely on bonds to provide them with the safety and income they need in today's environment. Hi, my name is Kobe. I'm an investment advisor. If you're new to my channel, I focus on helping Canadians safely build wealth and pay fewer taxes. In today's video, I will tell you how a proper portfolio should be positioned and what is the recommended asset allocation in high inflation, low interest rate environment. So let's jump right in. From a long-term perspective, equities are considered an inflation hedge. Overall, companies that can easily pass on higher costs should benefit, because pricing power is crucial both over the short term and medium term. Companies with pricing power should preserve or even improve margins and profits even if their costs are rising. For example, a company that manufactures a pill that cures cancer has a lot of pricing power. The demand for the pill will probably change very little if the price goes up. A manufacturer of detergent has much less pricing power. Consumers can easily trade away from one manufacturer's brand to another brand when prices increase. Financials should also benefit from higher inflation, especially if it followed by interest rates increases. Capital goods, construction materials, consumer services, transportation and metals and mining and value stocks in general should all benefit from both the economy reopening and higher inflation. Along with the equities, we recommend adding a sleeve of up to 30% in alternative investments. These are typically private assets such as private equity, private debt, infrastructure, and private real estate. This asset class can provide an additional source of returns that are not correlated to debt and equity markets. However, investors must manage risk, return, and liquidity considerations that may vary among the various alternative categories. I've made a video that talks about alternatives and privates. If you're interested, the link is in the description below. Lastly, when considering the asset allocation of the portfolio, you should take liquidity into consideration. If you need a fixed amount every year from your investment portfolio, you want to make sure that you have enough liquidity. When your money is invested in stocks, you are vulnerable to market volatility. While the value of your portfolio could go down, you only realize the loss when you actually sell. Having a good cash flow management strategy for your portfolio would help to cope with that. Take, for example, the Great Depression, which started in 1929. The Dow Index dropped 89% from peak to trough. If you had no liquidity, you would have had to sell stock for your income at a loss, effectively receiving 10 cents on the dollar. Now, if your withdrawal rate would have been 5% of the peak portfolio, you would have depleted your retirement savings in 2 years at the trough. Even after 89% drop, if you include deflation, dividends, and a broader market measure than the Dow, realistically, it took only 5 years for the market to recover. And that is why if you are retired, you would want to consider having at least 5 years worth of expenses in liquid investments to avoid selling at a loss during a volatile market. That's it for today's video. I hope you found it valuable. And if you haven't done that already, make sure to hit the like button. And if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.